investing. It's something which has been, I think, a topic of conversation over the last 3 to 6 months' time. So hopefully I'll be able to make a lot more sense. I'll also talk a little bit about the two funds that we have, the S&P 500 and NASDAQ, which I think are extremely popular today. I used to manage a lot of money for ultra HNI clients in the US. So before this, I was in San Francisco, where I was running a fintech company where we were managing money for ultra HNIs. And what we saw was, almost all of my clients, I had between 800 to 1,000 of them, had between 20 to 40% of their allocation towards equity outside of the US. Yes, it is a bit of a niche thing in India so far, but I do think that over the next 5 to 10 years time, I feel most investors will have some allocation towards international equity. The opportunity, why is international investing very important? I think it's to do with, how much, what the amount of home bias that we have as investors have today. If you look at India today, India is obviously a growing economy. It's doing really well. It's one of the fastest growing countries in the world. But if you look at India from a global standpoint or a macro lens, India is only 3.5% of global GDP market share. So we are currently missing out on 96, 97% of global wealth creation opportunities that's happening outside of India. So I think that is where a lot of opportunity is. And if you look at the US markets, which is, I would say, the most obvious market to invest in, that is the opposite. It's not the world's fastest growing, but it's also it's the world's largest GDP. So I think the combination is quite unique. Just by adding, say, a diversified US fund like the S&P or the NASDAQ, you're increasing your allocation from 3.5% to close to 25, 27%. You're actually capturing a lot more of global growth in your portfolio. The US markets and Indian markets are not very correlated. They don't move in the same direction. So what happens is when you're buying a US market, you're actually diversifying your portfolio a lot, and you're actually getting some downside protection in case Indian markets do not perform. The correlation comes down to 25, 30%. In fact, for NASDAQ, it's less than 20%. So I do feel that what that means is that as an opportunity, it's lowering your portfolio volatility dramatically and also giving downside protection. Apart from that, I think a very important point is that today, because of the uncertainty in the investment environment, we feel that a lot of investors are today looking to diversify. They're looking to buy gold, looking to buy debt, looking to buy real estate. But the problem with those asset classes is that they are not as high return oriented than equity. Equity is obviously the most highest returning instrument over the long term. So I think with international equity, you're actually getting equity returns without, so you're actually getting diversification opportunity without letting go of returns, which I think is extremely important as one such avenue where they can get the benefits of low correlation, but also the same level of returns. In fact, last 10 years, international equity has done a lot better than India overall. This is the most important point. I would say this is a central point to why I think every investor should have a minimum of 15 to 20% allocation towards foreign equity through diversifying mutual funds. International investing, you're actually buying two asset classes. One asset class you're buying is some of the world's best companies, best brands, global companies, global business models, all of that. But the second asset class which you're buying in the same fund is the US dollar. And we all believe that the US dollar today is a lot more important than the US dollar used to be, say, 10 years ago. I believe that the INR, the rupee, has depreciated by 3.5 to 5% every year over the last, I would say, 10 years, and in fact 3.5% over the last 20 years. So I think and today, if you look at our consumption patterns, we are doing a lot more foreign trips. We are sending our kids to schools abroad. We are buying a lot more goods and services like the iPhone. And the reason why these things are becoming a lot more expensive is less to do with, I think, pricing of the product. It's more to do with, I think, how the dollar has behaved from a weakening rupee, and I think that it adds to your returns as well. So for example, we have been running the NASDAQ fund for now almost 9 years. And the NASDAQ in the USD has grown around 7.5 times. So 7.5x, so 770% over the last 9 years, or last 15 years actually. But the INR version has grown almost 13 to 14 times. So the difference between 7 and 13 times is a very interesting index. It's the biggest fund in the world. It's the largest index, I would say, in the world. It represents the entire large cap universe in the US. So you're looking at buying the top 500 companies in the US, very similar to the Nifty 100 index in India. So I think it's a very, I would say, broad-based index. It covers 86 to 87% of the entire US market cap in just one single fund. And I think it's generally how I think the most popular index, which is a good gauge of the economy. So I think it's the best factors of how people gauge the economy. Unfortunately, recently it's not been a good gauge of the economy because the economy is not doing well, but the index is doing well. But overall, I think over the last 10, 15 years, if someone wanted to ask how the economy is doing, they look at the S&P 500. It's also the world's largest fund. Currently it manages close to, I would say, $3.5 to $4 trillion, which is more than India's GDP in just one single fund. Advantages of the S&P 500 is how diversified it is. The S&P 500 is actually one of the most diversified indexes out there. It is well diversified across different industries over the last 10 years. And even though, yes, information technology has picked up a lot post-COVID, I would say if you see the S&P 500 over, say, a 10-year period or a 20-year period, it's actually a fairly diversified index, which I think is great. And also, I think even if you look at the top 10 stocks, they're pretty much only a quarter of the index, which I think is pretty good, talking about the size of the entire index. So I think very diversified, very broad-based. And I would say number of companies is also a lot higher, which is why I think it's a great index. Lastly, even though this index is listed in the US, so you're looking at buying American companies, what we've seen is that this is actually a global index. If you see the quality of companies, they all have global business models. So you're looking at 40 to 45% of the entire S&P 500 universe having revenue coming from outside of the US. And it's also a biggest fund. So we had a lot of success in this fund. But basically what the NASDAQ it's not really a top 100 companies. It's the largest non-financial companies that are listed on the NASDAQ exchange. It's also not as diversified or than the S&P index. And the top 10 stocks are about 50 to 55% of the index. This is a very important point. Yes, the valuations are quite heightened at this point of time. So investors looking to buy these indexes, I would say should keep that in mind. We are, as an AMC, recommending investors to do an SIP-led approach. An average election year, the index makes around 7% in returns. So it's always positive. What we've seen is also in a non-election year, the index makes 7%. So what that means is that there's not really any impact of elections on the stock market. I think the US is a very hardcore capitalistic nation. So I don't think economics and stock market really go together. So I think, yes, investors can expect heightened volatility before the elections coming in November, but don't really base your decisions on who wins, who loses. I think it's not really, yes, it is a big event, but for a long-term investor, it's not really something that you should be looking at.
Thank you so much, sir. The next question coming from our guest is there a provision to invest in the IPO there?
In the IPO? So yeah, so you can invest in IPOs if you go directly. I'm not sure, maybe not through the funds at least we have, the two funds that we have, but yeah, if you go directly, then there should be opportunities for you to invest in IPOs there. So you have to set up a foreign brokerage account and send money abroad and all of that. But yeah.
Thank you so much, sir. The next question is, please throw some light on the taxation aspect for an investor for the fund.
Yeah, so taxation is very important. Even though as an asset class it's equity, as per income tax lens, it's actually a debt fund. So you will be taxed like a debt fund. So I think you'll have slab around 30% for the first 3 years, and then that goes down to say 20% plus indexation. So what indexation means is basically you can adjust your purchase price by inflation. So if you wait for a very long time, say 3-5 years, then I think your tax rates between equity and debt are pretty much very similar. But obviously, anyone who's taking a short-term bet should keep in mind that tax rates are relatively high. So which is also why I think I wouldn't recommend taking a short-term bet because even tax rates are quite high. So, but in a sense, these instruments are taxed as debt.
Thank you so much, sir. The next question is, International ETFs, especially on Indian exchanges, have had issues with liquidity in trade. Does MOSL also provide marketing making hence reduce the liquidity in the ETF?
Yeah, so so we have commercial arrangements with a couple of market makers. So we have three ETFs, and in fact, people who don't want to go through the ETF to buy our international funds can just buy the fund of funds, where they can go direct to the AMC, and we make sure you get a good price. So that was a solution towards to the low liquidity. But I think last 6 months, liquidity has increased quite a bit for ETFs in India. I think the spreads have come down, especially for a Nasdaq fund, because now it's a large fund. I think it's close to 1,700 crore. So I think it's a large fund. There's a lot of liquidity that we have on a daily basis, lots of buyers and sellers. But yes, I think you still never know. You might just have some crazy buyer, crazy seller who might go out there and just buy and sell. So I think investors should ideally, as I said, go to our website if you're buying the ETF and see and so we published the NAV data and the INAV every 15 minutes. So maybe you can look at that price and make sure that your price is pretty much close to that. If you don't want that hassle, then there is a fund of funds, which also gives you the same experience in terms of returns.
Thank you, sir. Next question is, do we see Europe or Japan or China, which will be the better run aspects over Nasdaq?
Yeah, I think it's hard to say. I think so Europe has I would say I think emerging markets are probably better placed than developed markets ex-US for the next 10 years. So Europe has had huge, I would say, sovereign problems, and I think even growth out there has slowed down dramatically. There's not a lot of innovation happening there. A lot of in the US companies have really populated deeply into these markets because they tend to be a lot more aggressive. So I think yes, if you're looking at a market outside of the US, which I really recommend, I think emerging markets might be a better bet. So if you look at China, Taiwan, Brazil, Indonesia, are the markets where there is a lot of fundamental, I would say, good growth on the ground. And so I think those are markets where I would say there'll be a lot more activity, a lot more wealth creation opportunities than say, I think maybe Europe and Japan, where there not seems to be, I think at least last 10 years haven't been any game changing when it comes to anything different to what's happening there.
Thank you so much, sir. The last question for the evening is, are you expecting correction in the market? If yes, how much?
I have, so I've said this before, I think no one can predict. And I believe that anyone who says he can predict, it should not be trusted. So I think that's where I end. So I would say, which is why I said, do an SIP. I do agree. A lot of uncertainty, valuations are high. So if people are on the risk averse side, then do an SIP, but don't try to time the markets. I think we've learned that, at least I've seen, and I have data to prove it also, that people who wait for corrections end up losing a lot more money. And in fact, people who get timing right end up losing and making less money than people who are just invested.